Hi, my name is Elliot Yu. I'm co-editor and publisher of Energy and Income Advisor. You may have heard of me or my firm because of some controversial sell calls we've made over the past 3 years concerning the global oil, natural gas, and energy markets. To my knowledge, my firm and I were the first to recommend selling deepwater oil drillers like Seadrill and Transocean more than 3 years ago. We recommended bailing out of these stocks before oil prices broke below $100 a barrel, and long before both names were forced to eliminate their dividend payouts, prompting declines of 90% or more in these once very popular high-yield energy investments. And late last year, following OPEC's decision to cut global oil production, our forecast that oil prices could fall from well over $50 a barrel into the 30s this year was decidedly outside the conventional wisdom. You see, at the time, virtually all strategists on Wall Street were calling for OPEC production cutbacks to send oil prices soaring to $60, $70 a barrel, or even higher by the middle of this year. And hedge funds were busy assembling a record-sized bet on higher oil prices in the global futures market. Just remember, by the end of February this year, hedge funds were long a record 1.01 billion barrels of WTI and Brent crude oil futures. In fact, some pundits laughed at our bearish oil call and recommendations to sell so many of the most popular energy stocks and MLPs. We told our readers to sell Energy Transfer Partners and Enbridge Energy Partners, despite their seemingly attractive yields of 8.3 and 9.2% respectively. And we advised selling oil services giant Halliburton, Canadian mega producer Encana, subsea equipment maker Drillquip, and contract driller Helmerich & Payne, all among the most popular and most widely owned energy stocks at the beginning of this year. However, the critics are now silent, with oil prices breaking down to $43 a barrel this month, Energy Transfer Partners collapsing 18.6% this year, Enbridge Energy Partners down 38.4%, and both of those companies announcing cuts to their distributions this year. Even many blue chip energy stocks like Halliburton have plummeted 20% or more, much more, so far this year. Listen, I didn't create this presentation to boast or brag. Rather, I reference our success calling the big moves in oil prices and energy stocks over the past few years because we believe global energy markets are in the midst of a historic and underappreciated shift. Simply put, the handful of investors who understand these shifts stand to make some serious cash in energy this summer while locking in impressive yields of 5%, 7%, or even 10% and more in well-placed, tax-advantaged MLPs. However, we are very worried that many individual investors are making a tragic mistake with their energy portfolios. Listen, our research confirms that some of the most widely recommended energy stocks, some that are being aggressively touted by well-known pundits and Wall Street analysts, are actually very dangerous investments right now. Meanwhile, some stocks and MLPs that are being widely ignored right now offer tremendous opportunities. Look, before I go any further, it's only fair that I should warn you. I don't mean to be rude, but if you're looking for a cheap tip sheet of 5 energy stocks to buy right now, then this presentation and our service probably aren't for you. The fact is that there are plenty of research services out there that offer that kind of advice on energy markets. However, that's not what we do. And I really don't want to waste your time today with this detailed presentation if you aren't interested in the sort of research we do at Energy and Income Advisor. And if you don't have at least $25,000 invested in energy stocks and MLPs, the truth is you probably won't be able to use the information I'm about to give you today in this presentation. Again, I don't mean to be blunt. However, the last thing I want to do is waste your time today. Some of what I'm about to tell you is controversial. I received plenty of hate mail from angry readers who disagreed with my sell calls on energy and oil at the end of last year. I just don't want to go through that again. So if you have a thin skin or prefer to focus on popular consensus investments that are touted on financial television and by most other pundits, you may just want to click away right now. However, if you are a serious energy investor looking to understand why most pundits have been so totally wrong about oil prices, energy stocks, and master limited partnerships over the past 3 years, I urge you to keep watching this presentation through to the end. In just a moment, I'm going to show you a quick 25-minute video presentation I just gave for a small group of my Energy and Income Advisor readers. Normally, this video presentation would only be available to that small handful of paid in full subscribers to our premium research services. However, I believe this information is so crucial to your wealth right now, I'm offering it absolutely free of charge today and only through this website. Watch this presentation through to the end, and I'll explain why the OPEC cartel, a dominant force in the global oil market for more than 5 decades, is now dead. And what we call ton is the new power in the global energy market. I'm not exaggerating when I say that this is a once-in-a-generation shift, and it's the most important reason why so many pundits have been caught so wrong-footed in energy markets in recent years. You could say that ton is the anti-OPEC, and I just can't stress this enough. You must understand what ton is and what forces govern ton's actions if you want to make serious money in energy stocks and MLPs over the next few years. In just a few moments, as part of this free presentation, I'll give you the most important facts you must know about the seismic shift of power from OPEC to ton and how it's opening up some shocking profit opportunities for investors. And I'll also outline the 5 factors I'm watching this summer to alert me when oil has hit bottom. I'll tell you exactly how you can watch these 5 simple bottoming signals as well, so you can cut through all the noise, hype, and quite frankly, total BS spouted by most energy market pundits and the talking heads on financial television. Listen, as I said, I don't normally offer up this sort of information free of charge. In fact, I may have to take this presentation down if I receive too many complaints from loyal and longtime readers. However, we believe this information is so timely and so crucial to your financial well-being, we decided we can't just hide it behind a paywall. Watch this presentation through to the end, challenge every single one of my facts, and you'll find that I'm right about each allegation I make. And then you can decide for yourself. I guarantee you won't be wasting your time. My first chart here is a very simple one. It comes from the BP Statistical Review of World Energy, which comes out every year. And this is the real, i.e. inflation-adjusted price of oil going all the way back to the 19th century, to 1873, up through the early 1980s. And so this is $2016 per barrel, so it's comparable between different time periods. Obviously, $1 back in 1873 is worth a heck of a lot more than $1 in 1981, or certainly today in 2017. So I've inflation adjusted these numbers such that oil prices in different time periods are comparable. It's all stated in 2016 dollar terms. The big thing to note here, and I just put a green circle up on your screen, look how long oil prices just remained pretty much range-bound, all the way from the very early part of the 20th century, and in fact, at times back in the 19th century, all the way up until about 1973, oil prices, and this is West Texas Intermediate crude oil, remained very, very range-bound. Between 1930 and 1973, oil prices were actually down in inflation-adjusted terms over that time period, over that total time period. So oil was pretty flat and stable at relatively low levels. But look what happened as we moved through the 1970s. From levels of around $11.50 in 1973, late 1972, again in inflation-adjusted terms, oil prices ran up almost to $110 a barrel by 1980. So basically a tenfold increase in the price of oil between 1973 and 1980 after decades of remaining at pretty much stable prices under $20 a barrel from 1930 all the way up until 1973. What happened? That's an amazing jump in a very short period of time. What happened was OPEC. OPEC was actually formed back in 1960, but it really began to manipulate global oil prices starting in about 1973. And like all cartels, supply cartels, and again, this OPEC stands for Organization of Petroleum Exporting Countries, the way cartels work is they control the supply of a commodity. By restricting the supply of the commodity or taking supply off the market, they can theoretically push up the price of that commodity. In other words, if global demand for oil is, say, right now 100 million barrels a day, and OPEC is producing, OPEC and non-OPEC countries are producing enough oil to meet that demand, but OPEC goes out and takes 1.5 million barrels a day off the global market, that is going to have a tendency to make demand outstrip supply and push up the price of oil. And that's exactly what they did starting in the early 1970s. You can see from the beginning of this chart, 1965, all the way up until 1973, OPEC oil production, which is that blue line on your chart, steadily rose basically more or less in line with the rise in global demand. The gap between OPEC production and global demand was made up by non-OPEC producers like the United States. These are countries outside the global cartel. But note what they did in 1973. First, they sharply cut their own oil production from over 30 million barrels a day in 1973 down to the low 22 million barrels a day range. And then it wasn't really until 1977, 1978 that they got back up to producing 30 million barrels of oil a day. But you can definitely see that OPEC oil production grew strongly along with global demand for oil from 1965 to 1973. And from 1973 to 1980, they more or less kept their oil production flat, even though global demand for oil continued to rise. So demand growth outstripped supply growth, and that resulted in that tenfold surge in global oil prices. Now, why did OPEC's production cuts work? Well, here's the thing, and this is basic economics, supply and demand. If the price of a commodity goes up, two things happen. There's two effects. One, demand tends to moderate. Obviously, if something costs more, people use less of it. Very simple. In the 70s, we did see some demand destruction. For example, power plants here in the United States switched away from burning oil to produce electricity. Back in the 70s, as much as a third of U.S. power was produced using petroleum products. In the 60s, today it's negligible. Only a few states really have petroleum burning plants. On the supply side, though, which is even more important to look at because that's what OPEC was manipulating, there's also an impact. Obviously, if the price of oil goes up, producers all over the world have an incentive to go out and produce more oil. Higher prices makes it more profitable to produce oil, so they're going to spend more money on drilling, on exploration and development, on new production. However, here's the problem. Supply is what economists call sticky. In the 1970s, oil supply was sticky. In other words, if OPEC manipulates their own output of oil to push up the price, and let's say the price goes up fivefold, which it did between the early 1970s and mid-1970s, there's an incentive for global producers outside OPEC to produce more oil to make more profits. However, it's not like they can just turn on the tap. It took years in the 1970s for companies to go out, spend, in modern terms, what would be billions of dollars of capital exploring for, drilling new oil fields, and producing more oil. This took years. So supply was sticky. It could only adjust slowly over time to the rising price of oil. So you can see on this chart, this is non-OPEC oil supply going from 1965 up through the late 1980s. And you can see that middle period there between roughly 1973 and 1976, 1977, non-OPEC oil production was roughly flat, even though oil prices were skyrocketing. It really wasn't until the late 1970s and early 1980s where non-OPEC supply finally began to react to higher prices for oil. and fields like the North Sea in the United Kingdom and Norway, Mexico's Cantarell oil field in the shallow Bay of Campeche, and the United States oil fields in Alaska were developed, put online, put into production, and began adding to global oil supply. So supply was sticky, and that's what allowed OPEC to manipulate the price of oil higher. They could adjust their production quickly within a matter of months or weeks, whereas it took years for non-OPEC producers to increase supply to offset those OPEC production cuts. That's why OPEC was so effective in the 1970s with pushing up the price of oil tenfold. And you can see here this little red circle I've drawn on your chart showing you that flat production in the mid-1970s, straight through the mid-1970s, fairly flat production, even though the price of oil was sky high. So that's how OPEC worked in the 1970s. And so the key question that we needed to ask ourselves from the early 1970s up until really the last 5 or 6 years is what motivates OPEC? If you wanted to know the price of oil, then you have to know what motivates the cartel that controls global oil supply and controls, largely, global oil prices. Well, what motivates OPEC? Some countries in OPEC, and this is a picture of literally a bread line in Venezuela, individuals in Venezuela just over the last few months waiting for hours in a queue, in a line, to get into a grocery store and buy what very few products were on the shelves in those grocery stores. Here's a picture of pretty much empty shelves or very understocked shelves in Venezuela. The Venezuelan economy is literally imploding. It's tragic this year. 600% plus rates of inflation. You have riots in the streets. The government of Venezuela, led by Nicolas Maduro, who is a socialist, who succeeded Hugo Chavez as president of Venezuela, is really fighting to stay in power. And there's a lot of popular uprising against these economic catastrophes going on in Venezuela. And as a result, Maduro needs higher oil prices, needs oil prices to go back up to $50 or $60 a barrel if he has any hope of literally paying to stay in power, providing subsidies for the poor in Venezuela, for the middle classes in Venezuela, getting enough food for people to eat such that maybe the population won't rise up and end up in civil war. Other countries in OPEC are motivated by very different things. This is actually a picture, or actually a sort of schematic, of a housing development in Saudi Arabia. The Saudi Arabian government, as you probably know, the Saudi royal family, the leadership in Saudi Arabia is very, very rich, very, very rich people. But there's also a lot of young, poorer people who live in Saudi Arabia. And one of the ways that the royal family stays in power and avoids problems such as were created following the Arab Spring a few years ago in North Africa and other parts of the Middle East is by offering very generous subsidies and social spending to keep poorer Saudis happy. One of the things they do is offer subsidized housing, and that's what you see in this picture right here. And his name is Mohammed bin Salman, and in many circles he's just being referred to as MBS for short. He is the current king's son, and he's 31 years old. One of the big pushes he's made over the last couple of years, since kind of rising to really high up in the ranks in terms of policy decisions in Saudi Arabia, is to try to diversify the Saudi economy away from just oil into other industries, because right now the Saudi economy is heavily reliant on oil export revenues for income. One of the ways he plans to do that is by doing an IPO, initial public offering, of Saudi's state-run energy company, Saudi Aramco. Another thing that's motivating Saudi Arabia to want higher oil prices right now is that they want to push up the price of oil before they IPO Saudi Aramco next year, so they can get a better valuation for their energy company, which could be worth literally trillions of dollars, maybe the most valuable company on earth once it comes public, if the price of oil is healthy. So those are the types of things that motivate OPEC. But OPEC, as I said, and I'll show you in just a minute, is losing power. And just a little preview, the reason they're losing power is that global oil supply is no longer sticky like it was in the 1970s. There is, however, a new power in the global oil market, which you can see on this slide, that I like to call TONN. And the acronym here, it's an acronym, and it stands for Texas, Oklahoma, New Mexico, and North Dakota. 4 of the states that are at the center of the shale boom. Texas because of the Permian Basin, which is comprised of the Midland and Delaware basins, the Eagle Ford Shale. Oklahoma, the South Central Oklahoma Oil Province, or SCOOP, and the Sooner Trend, Anadarko, Canadian, and Kingfisher Play, or Stack Field, both located in central Oklahoma. New Mexico also has a piece of the Delaware Basin of the Permian, located in the southeastern corner of the state, in Lee and Eddy counties, and North Dakota is best known for the Bakken Shale. These 4 states have resulted in a humongous surge in oil production over just the last few years. This is a truly amazing chart in my view. I've put the production from all 4 of these states on this chart. And you can see that as recently as early 2011, really the first half of 2011, these 4 states were producing less than 2 million barrels of oil a day. At their peak in mid-2015, these 4 states were producing 5.5 million barrels of oil a day. So that's literally a 3.5 million barrel a day increase in oil production from just these 4 U.S. states, from these shale fields that are being developed at an increasingly rapid rate and an increasingly more economic cost. Now, there's a big difference between TONN and OPEC. I showed you politics, domestic politics, the need for social spending, wars, conflicts between different OPEC members. These are all things that motivate OPEC's decisions to cut or increase production or hold production constant, do a freeze, have a meeting, try to talk up the price of oil. With TONN, it's all about simple economics. Now, this is a chart, this is a slide from a company called Parsley Energy. Is one of many, many companies that we cover in Energy and Income Advisor. Their main base of operations is in the Midland Basin, which is part of the Permian Basin in West Texas. It's located on sort of the eastern side of the Permian Basin. It's heavily an oil play. It's one of the most economic oil fields in the United States. And this slide shows you the type of returns that Parsley Energy is getting at various different prices for West Texas Intermediate or WTI crude oil. And you can see that at $40 a barrel WTI, that little chart on the upper left-hand side of your slide, some of their more modern wells, which are costing around $5 million for drilling and completion costs, are still offering a more than 50% return on capital invested because these wells are just so prolific. New technology is just unlocking more and more oil in this region. Under every square mile of ground in this part of the Permian Basin, there's a cubic mile of oil saturated rock. That's truly an amazing statistic. The Permian Basin is thought to be the largest oil field in the world, even larger than the Ghawar field in Saudi Arabia. At $50 a barrel oil, Parsley is making 100% return on their investment, and at $60 a barrel oil, it's more like 170% return on their investment at that lower end in terms of well cost. And they continue to drive down the cost of their wells. So what motivates a producer in TONN like Parsley Energy? If they can make money, if they can earn a high return on investment from drilling new wells, regardless of what that price might be. So in other words, if Parsley Energy can make 52% return on their investment at $40 a barrel oil, they're going to drill more wells. They're not motivated by politics. They're not motivated by collusion with other producers. In fact, that's illegal in the United States. They're motivated by simple economics. And they've been highly successful in driving down the cost, the break-even cost of producing from fields like the Permian Basin of West Texas. Now, this is an interesting chart, I believe. You have 2 lines here. The gray line on this chart is the price of West Texas Intermediate crude oil, and that's based on the scale on the left-hand side y-axis. The orange line that you see here is U.S. oil production, and that uses the scale on the right-hand side of your chart. Now, what you can see here is that, as I said, back in the 70s, global oil production outside OPEC was sticky. Therefore, OPEC could control the price for years without seeing a supply response from non-OPEC producers. Absolutely no longer the case. TON is what we call short cycle. They've totally destroyed OPEC's power. When the price of oil collapsed from over $80 a barrel at the end of October 2014 to the 20s in early 2016, U.S. oil production declined over this period. Why? Because producers couldn't make any money at $20, $25, $30 a barrel crude, so they took rigs offline. They tried to save money. They spent less money on drilling, and eventually that resulted in falling U.S. oil production. But notice what happened when the price of oil climbed back over $40 a barrel in the spring, early summer of 2016 and got up over $50 a barrel in early 2017. You can see that stable oil prices in that $40 to $50 barrel range, even around $40, $45 a barrel, was enough to prompt these producers to put rigs back to work. Because as I showed you on this slide, many producers in plays like the Permian Basin can make a ton of money at $45 or $50 a barrel oil. So they started putting more rigs back to work. By the end of October last year, with oil prices stable in that $40 to $50 a barrel range, U.S. oil production was already rising very, very rapidly. U.S. oil production is up almost 1 million barrels a day over the past year, since last summer, since last September. So U.S. oil production can respond very quickly. The ton producers can respond very quickly because when the price of oil rises, they can make money. They start drilling more aggressively. Within 3 to 6 months, that results in higher U.S. oil production. They can adjust very quickly to changes in OPEC policy. If OPEC cuts production and pushes the price of oil up like they did in the 70s, TON just comes in with more supply and very quickly, within 6 to 8 months, offsets those OPEC production cuts. And that's why the price of oil hasn't been able to rise above $55 to $60 a barrel this year, and is now trading back down in the low 40s. This is, by the way, not a new concept for us. In Energy and Income Advisor, we've been saying since late last year that OPEC production cuts will not work because TON is short cycle, and production from TON will rise so quickly that it'll quickly offset any production cuts that OPEC wants to make. Here's another look at the same trend. The orange line is U.S. oil production. The blue line is the U.S. active oil-directed rig count, the number of rigs actively drilling for oil and gas in the United States. You can see that last May, the U.S. rig count bottomed out around 316 active rigs. U.S. production, it began to rise by July and August. U.S. oil production stopped falling at that point. And by October, November, it was rising again alongside the rig count. It takes only about 3 to 6 months for a change in the rig count to result in higher U.S. oil production. So why can't OPEC, and here's a question I get all the time, why can't OPEC just go out and cut more production to try to drive up the price of oil? There are a number of reasons. One is it would be difficult to agree to additional cuts. A lot of countries within OPEC have just spent billions of dollars trying to expand their production capacity. Now, they're willing to not put that production capacity online for 6 or 12 months in order to push up the price of oil, but eventually, at some point next year, a lot of them are going to want to recoup some of that investment by putting that oil production into work. You also have the problem of so-called exempt countries. These are countries that were exempted from the production cuts that OPEC agreed to last November. Nigeria and Libya, they've both had civil unrest in those countries. Nigeria, militants in the Niger Delta region. Libya, literally a civil war between the two halves of the country. That's obviously impacted oil production. And OPEC felt that these countries needed to be allowed to increase their oil production back up to more historic levels. But it's a big problem. Libya was producing less than 300,000 barrels a day at one point last year. Soon they're going to be producing, I believe, over 1 million barrels a day. That's a lot of new production. Nigerian production was down to 1.1 million barrels a day at one point last year. Now, soon it's going to be up over 2 million barrels. That's a lot of new production coming online and complicates OPEC measures to cut production and push up the price of oil. Some countries are already struggling to comply. Iraq, huge spending domestically to keep down militants, and that costs them a lot of money. Their temptation is to cheat on production cuts. Those are all reasons why OPEC can't just go out and cut more, why it's difficult to agree to additional cuts. But the most important reason is what I said earlier. Additional cuts from OPEC would boost oil in the very short term. I should have put very in there. But would also result in a rapid production response from TONN and U.S. shale. OPEC loses market share when it cuts production because it cuts production and the shale producers fill that gap and take higher market share. OPEC has no lasting power. Shale and TONN are the world's swing suppliers, and economics of shale are bound at approximately $40 to $60 a barrel. Price of oil goes far below 40. A lot of producers in the U.S. can't make money. They cut back on drilling, and production eventually declines, helping to push the price of oil higher again. Up at $55 or $60 a barrel, these companies are literally minting money. U.S. production rises very rapidly, TONN production rises very rapidly, and push back down the price of oil. I think you're going to see oil largely bound in this range, $40 to $60 a barrel, for years. Therefore, you must pick stocks that can thrive and generate growth and cash flow with oil around $50 a barrel. That certainly doesn't apply to all energy companies out there. Now, I want to move quickly on to 5 factors I'm watching to tell me that oil is near a bottom. The reason I think oil is going to bottom out this summer is that everybody's been focused on OPEC for all the wrong reasons. They're stuck in the past. They're stuck in looking at fundamentals that haven't worked in years. The real change that's going to push up the price of oil in the second half of this year is that with oil prices closer to $40 a barrel, U.S. production growth should slow, and that will deliver an actual production cut that will tighten up global oil balances, drive down global inventories, and that's what's going to turn the oil market. Here are some specific factors I'm looking at to time this turn. First up, the Commodity Futures Trading Commission website, CFTC.gov. They publish a weekly report every Friday called the Commitment of Traders Report. You can find it on their website. You can look at exactly the data I'm looking at right here. What I look at is money managers, which means hedge funds, gross short position in the crude oil futures market, the West Texas Intermediate crude oil futures market. Now, this is a contrarian indicator. When there are a lot of shorts in the oil futures market, it tends to mark a bottom for oil. Examples, back in early 2016, which you can see kind of towards the left-hand side of this chart, hedge funds were short over 200 million barrels of oil, and that marked a low for oil. In last August, they were short over 220 million barrels of oil as of August 9th. That marked a bottom for oil around $39 a barrel when it marched all the way up to, eventually all the way up to $55 and change. Right now, there are about 124 million barrels short position by hedge funds. Again, new data coming out every single week. I'm looking for that to get up more like 170 to 225 million barrels short before oil is likely to bottom. It's a great contrarian indicator. You can find it CFTC.gov. Oil bottoming factor 2, watch the rig count. Every week on Friday, 1 o'clock Eastern Time, Baker Hughes, go to bakerhughes.com, publishes their rig count numbers. This is the number of rigs actively drilling for oil in the U.S. This number bottomed out at 316 rigs last May. I'm talking May of 2016. It now stands at 747 rigs. A more than doubling in the rig count has resulted in 1 million barrels a day of incremental production from TONN from U.S. shale. What I'm looking for is the steady rise in the rig count we've seen over the past year or so to flatten out and decline. This will indicate that U.S. producers are responding to lower oil prices near the low end of that range that I talked about, $40 to $60 a barrel, by cutting the number of rigs they have working, or at least slowing the growth in the number of rigs working. That will result in a moderation of U.S. oil production growth, which has been growing at close to 100,000 barrels a day every single month. That will be a key bottoming factor for oil prices. Also look at the weekly production and inventory figures released by the Energy Information Administration, EIA.gov, every Wednesday at 10:30 in the morning. Oil bottoming factor 3. This is just simply a chart of what a typical oil price bottom looks for. This is the oil prices from late 2015 through middle of 2016, so a year and a half ago roughly. You can see that between the end of 2015 and late January of 2016, so less than a month, the price of oil fell by a third. It rallied a little bit on pretty strong volume actually, sold off again in February, and touched that same level before we finally saw a durable advance in oil prices. The simple fact is that bear markets, as a general rule, in all markets, not just oil, tend to form faster than tops. It takes longer for a top to form in a market than a low. And lows are characterized by panic and extreme moves. So look for a quick whoosh lower in oil prices. I think it could go down into the upper 30s somewhere, followed by a strong advance, maybe a retest of that low like we saw in early 2016. That just simple technical indicator pattern, just look at the pattern. You want to see panic. You don't want to see what we've been seeing lately, which is the price of oil goes down and then you see this weak bounce, up 50 cents the next 2-3 days. That's just short covering. That's short term. Look for a dramatic sell-off followed by a dramatic high volume advance, possibly a retest of that low. That'll tell you that oil's bottomed. I think it's likely to happen sometime this summer. Oil bottoming factor number 4. It's called the Oil VIX. You might have heard of the VIX, the S&P 500 volatility index. When the VIX is high, you buy. That's the old adage. All it measures is the amount of volatility priced into the options market. It's very similar in some ways to the pattern I showed you on the prior slide. Near market lows, there tends to be a lot of fear in the market. That shows up in the form of a lot of volatility priced into options prices. And for the stock market, that works, but it also works for oil. There is an oil VIX. It looks at the volatility priced into the oil options market. You can find it on a website like a Google Finance. Type in OVX as a symbol. You can see that in early 2016 on my chart, the oil VIX got up to almost 79. In last November, right before the OPEC meeting, when oil bottomed out, saw a big bottom, it got up over 50. And this year, it's topped out as high as about 40. I think that you need to see the oil VIX spike up to at least the mid 40s, around 45, to maybe up as high as 55 before oil will bottom. Another factor to look at. The final factor, listen to second quarter conference calls from the big high quality exploration production companies. In their first quarter, they outlined plans to ramp up drilling activity and oil production in the second half of this year. Not all of them, but a lot of the big names. You want to look at companies that are operating in the Permian of West Texas and New Mexico, the Bakken Shale of North Dakota, the Scoop Stack fields of central Oklahoma, the Niobrara Shale of Colorado, and the Eagle Ford Shale of southern Texas. What I want to see is that with oil prices closer to 40 than 50, will these E&Ps, these exploration and production companies, begin to talk about scaling back their drilling and capital spending plans? Any signs that they're going to do that would have a big psychological impact on oil prices because it would mean lower U.S. production growth. I know this is a qualitative, not a quantitative factor, something to watch. You can go to the websites of companies like Parsley Energy, I showed you a slide of a few slides back, and actually listen to their quarterly conference calls in July and August. That'll be another indicator. Obviously, I'd be surprised if all 5 of these indicators line up perfectly, but these are 5 factors I'm looking for, and what you want to look for is kind of a preponderance of the evidence. So there you have it. OPEC's power is dwindling, and the forces of TONN, that's Texas, Oklahoma, New Mexico, and North Dakota, now control global oil prices. Unlike OPEC, TONN is motivated solely by prices, profit, and credit, not Middle Eastern politics, social spending needs, or a desire for fair or stable oil prices, whatever the heck that means. Listen, I know I just threw a ton of information at you in a pretty short period of time about oil supply, prices, futures markets, even quantitative trading. And some of what I've told you in this presentation may be very different from what you're hearing from other pundits out there and talking heads in the media. However, just remember, only 3 short years ago, many of my peers in the financial research business thought I'd lost the plot when I recommended selling high-flying, high-yield stocks like Seadrill and High Crush Partners. And just 6 months ago, most Wall Street analysts were looking for $60+ a barrel crude. This year, while hedge funds were absolutely gorging on crude oil futures to play the so-called post-OPEC surge in prices. However, Seadrill now sells for less than 50 cents a share, a penny stock. High Crush is down 87% from its 2014 highs, having eliminated its distributions. And oil has tumbled more than 24% from its highs back in February, producing billions of dollars in losses for those bullish hedge funds in just over 3 months. The problem is that many pundits are still in serious denial about the shift in power away from OPEC, and they're still trying to forecast energy prices based on fundamentals that haven't been relevant in years. I can't stress this enough. You need to act now to protect your energy investment portfolio and set yourself up to benefit from the exciting, once-in-a-generation shifts underway in the oil, MLP, and energy markets. So as I promised earlier in this presentation, here are the 4 profit steps you should take. Profit step number 1, the unsung energy commodity. When it comes to energy markets, crude oil always seems to grab the spotlight. Sometimes you might hear a pundit talking about natural gas prices on financial TV, and very rarely you might even hear a story about coal, usually around election time. However, let me ask you this. How many times have you heard anyone talk about natural gas liquids prices? Natural gas liquids, or NGLs, include hydrocarbons like ethane, propane, and butane that are found with oil and natural gas in fields all over the U.S. Just as U.S. shale natural gas and oil production has boomed in recent years, so has production of these NGLs, used in all sorts of applications from manufacturing plastics to, believe it or not, ripening fruit. In fact, the U.S. is now arguably the lowest cost producer of these NGLs in the world, and that's starting to attract a ton of attention, even in the traditional suppliers in the Middle East. Even Saudi Basic Industries, which is Saudi Arabia's massive, partly state-owned chemical company, has recognized the opportunity, and it's working on a JV with ExxonMobil to produce ethylene on the U.S. Gulf Coast using low-cost ethane produced right here in the U.S. In total, some of the largest chemicals and energy companies in the world, including Dow, Formosa Plastics, Sasol, Westlake, ExxonMobil, and Chevron, are constructing ethylene plants in Texas and Louisiana that will consume more than 500,000 barrels a day of U.S. ethane supplies. All of this new capacity is slated to come on stream between the second half of this year and 2019. Plus, the U.S. is also becoming a key exporter of natural gas liquids. U.S. ethane exports alone have roughly doubled to nearly 30 million barrels per year between 2014 and 2016, over just 2 years. Think about it. Producing, processing, transporting, and storing all of these NGLs needed to feed these new petrochemicals plants, and all of these NGLs that are destined for export to Europe and Asia requires a ton of basic infrastructure in the form of pipelines, processing plants, and storage and export terminals. Well, we've identified a handful of companies that have positioned themselves to benefit from rising volumes of natural gas liquids produced here in the U.S., exported, or consumed in petrochemicals facilities. The list includes a low-risk blue-chip MLP with a growing 6.4% yield, and a midstream energy firm sponsored by one of the largest independent oil producers in the U.S. that's currently yielding over 10%. I don't have time in this short video to go through all the stocks we've identified that will see real benefits from the U.S. NGLs and petrochemicals boom. However, I've assembled all you need to know about this trend and 5 stocks that we're recommending you buy right now in a special hot-off-the-press bonus report titled Profit from the U.S. Petrochemical Boom. Best of all, in just a moment, I'll explain how you can get a copy of this detailed report immediately with no risk or obligation, but only through this website. However, first I want to tell you about this. Profit step number 2, the biggest day of the year for income investors. Listen, we don't believe you can make money in an ivory tower. While it's certainly important to read financial statements, update your earnings models in spreadsheets like Excel, and listen in on quarterly conference calls, we found that some of our best recommendations and industry insights come from attending energy conferences and analyst day events all over the country. One of my favorite events of the year, the MLP Association or MLPA conference held in June in Orlando, Florida. It's an event attended by senior management teams from dozens of master limited partnerships, and it offers us the opportunity to ask questions directly and dig up real insights on this high yield, tax advantage group. One of the most profitable investment angles for us over the years has been to focus on some of the smaller, under the radar MLPs that attend this conference. These names aren't major components of the popular MLP industry ETFs, and they're not as widely covered on Wall Street. While there are many smaller MLPs we wouldn't touch, we have been able to dig up a handful of gems each year that offer above average yield and growth prospects. We sent a team of 3, myself included, to this year's event less than a month ago. And following the event, we recorded a 2-hour-long presentation covering all of our key takeaways and specific recommendations. The list includes 6 conservative recommendations, offering safety-first yields in the 4 to 7% range, plus low-risk potential to grow their payouts over time. Plus, we identified 5 more aggressive names, some offering yields of 10% or more, that we believe could see capital gains of 20 to 30% over the next 6 to 12 months. And just remember, it's just as important to know which stocks and MLPs to sell right away as it is to know the best names to buy. Our detailed MLP strategy session, a perennial favorite with our readers, lists 8 MLPs that we believe to be very dangerous investments right now, including 4 large cap names that many, probably most individual investors own. Look, I don't have time to explain all the key takeaways, buy recommendations, and sell calls our team gleaned from the MLPA conference earlier this month, but I want to send you a link so you can hear all of our insights for yourself. Trust me, if you're an investor interested in yield, you'll want to get started right away, buying some of our high yield recommendations and selling any of these dangerous MLPs that might still be lurking in your portfolio. I'll show you how to gain access to this detailed video strategy session and our 52-slide presentation deck in just a second as part of our risk-free, endless summer trial to Energy and Income Advisor. And that brings me to this, profit step number 3, heaven and hell, the best and worst energy stocks for the rest of 2017. Look, as we explained earlier in this video, we believe time is of the essence this summer. We believe oil is within weeks, probably just days, of a major bottom, while an epic rotation into energy stocks could start as soon as July 5th, the first real trading day of the third quarter. You see, our research confirms that fund managers are massively underweight energy shares right now, and sentiment in the oil market is near levels that have historically marked a crucial bottom. In fact, the last time our 5 key oil bottoming indicators lined up like this, some of our top energy recommendations surged more than 80% within 6 months. The bottom line, while we want you to read all of our research on the energy markets and individual stocks, we also know it's absolutely critical that you get started with our key recommendations right now. To make it as easy as possible to make your first move, we've created this special report detailing 1 top energy stock to buy for the second half of this year and 1 name, a stock that way too many individual investors I talk to hold. You must sell right away. These are 2 of our highest conviction calls for the second half of the year. And I want to send you a copy of Heaven and Hell, the best and worst energy stocks for the rest of the year, as part of a risk-free trial to Energy and Income Advisor today, so you can profit from our advice starting immediately. And that brings me to this, profit step number 4, big yields from the Great White North. My colleague and co-publisher, Roger Conrad, has been covering Canadian markets for more than 2 decades. He's won industry awards for his work analyzing Canadian energy stocks, and he's a popular guest on Canada's Business News Network television programs. Recently, on a Friday evening, Roger called me to tell me how excited he is by the opportunities he's seeing in the Canadian energy market. You see, not only is Canada a key supplier of oil and natural gas, but because many of Canada's largest fields are located far from population centers, oil and gas prices there have been much lower than in the US for years. The result? The best Canadian companies have cut costs to the bone, and they've boosted efficiency to the point that they can make money at incredibly low commodity prices. One producer Roger told me about with acreage in the Montney Shale can produce natural gas for 23 Canadian cents. That's just 17.5 US cents per thousand cubic feet. They're literally minting cash flow, even with gas prices near 2-decade lows. Even better, many of Roger's top plays in Canada have a long history of paying impressive dividends. Canada's resource wealth is such an important topic and so timely right now that Roger just put the finishing touches on a special premium report entitled Big Yields from the Great White North, featuring 3 of his highest conviction dividend-paying recommendations based in Canada. I want you to be among the first readers to review this premium report, and I'll rush you a copy in convenient PDF format immediately as part of our special, limited-time, endless summer trial to Energy and Income Advisor with no risk or obligation. In just a minute, I'm going to tell you exactly how to receive all 4 of these bonus reports, access to our subscriber-only Energy and Income Advisor website, and separate model portfolios tailored for growth, income, conservative, and aggressive investors, MLPs, and Canadian recommendations through August 31st this year with zero risk or obligation. However, first, I want to tell you about what the majority of our readers agree is the most valuable bonus of all for our service: our monthly online question and answer web chats. Listen, what if I told you that you can log onto a website and type in any questions you have about individual stocks, the market, oil, gas, coal, and have those questions answered by me or Roger Conrad in real time? Our monthly strategy sessions are like private coaching sessions, which we handle personally, no matter how long it takes to get through all of the questions and follow-ups you may have. In fact, we've stayed online for as long as 12 hours answering questions from our readers. And we absolutely don't shy away from tough questions. No one screens, filters, or edits the questions we receive. To our knowledge, no other firm in our industry offers this sort of direct access as a regular monthly feature of their service. However, we believe these monthly web sessions are particularly critical in volatile market environments such as we're seeing in oil and energy stocks today. You see, major bottoms and lows in all markets are typically marked by breakneck volatility and extreme moves, and our monthly chats mark an ideal time for us to address any fears and concerns about individual stocks or the market you may have, and to keep you up to date on our most recent advice and outlook. Normally, we would not offer access to multiple monthly web chats to trial subscribers to Energy and Income Advisor. However, as part of our endless summer promotion, you will be eligible to attend all of our monthly chats, plus receive any subscriber-only webinars or bonus reports we publish through August 31st with absolutely no risk or obligation. Click the Start Your Risk-Free Trial button below this video to sign up for your risk-free trial to Energy and Income Advisor today, and I'll reserve a spot in your name on our next monthly web chat immediately. We've never extended a guarantee or a package of bonus reports like this for Energy and Income Advisor trial members before. However, because we're so convinced this summer will be a crucial turning point for oil and energy stocks, we want to make our service as simple and risk-free to join as possible. Click the button below this video and sign up for a trial membership to Energy and Income Advisor today at our discounted charter membership rate. We'll rush you your login credentials to access our secure, members-only website. Test drive our service, read all of the bonus reports I've mentioned in this presentation, attend our monthly online web chats, and review our detailed model portfolios for the entire summer through 5 p.m. on August 31st, and only then decide. If you don't believe Energy and Income Advisor is worth every penny of the subscription cost, cancel by 5 p.m. Eastern Time on August 31st, and we'll refund 100% of your subscription price with no questions asked and no hard feelings. However, please hurry, as on July 5th, we're closing this offer down forever, including our endless summer extended risk-free trial period. Here's to your wealth. Click the Start Your Risk-Free Trial button below this presentation and join us today.